Good morning and welcome to this Monday, April 20th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. All right, well, we ended last week, which was options expiration week, on a pretty good note. We can take a look at those indices. Things are a little rougher this morning with futures, and this particular week coming up historically is not a good week. It's the week after options expire. And from the 19th through the 25th of all calendar months, those 7 trading days have historically been the worst for the stock market. And I think a lot of it is related to options expiration. The worst day of the week historically has been Monday. If you go back the last 70 years, Monday has an annualized return of minus 15% on the S&P 500. So Mondays typically, I think a lot of it's psychological. You just, who likes to go to work on Monday? I think some of that has an impact. But the Mondays that follow option expiration Friday tend to be particularly bearish. So I'm not shocked that we're seeing futures down today. And to be quite honest, I'll talk about the S&P 500 and look at a chart in a little bit, but this would be a level where we could see a pullback. I mean, I thought we'd see one last week, and we did start off the week with some selling last Monday, and then we had a big gap down on Wednesday, but the market was very resilient. So taking a look at the action here, you can see the Dow Jones Industrial Average on Friday was up 705 points, almost 3%. The S&P 500 up 75 points. Which was close to 2 2/3%. The NASDAQ up only 1.4%, up 117 points. We'll talk about that underperformance in just a minute. The mid caps up 3.7%, small caps 4.5%, so better performance there. And then when you look across, here are the individual sectors that performed well last week. And if you look across the board, energy, financials, industrials, materials, real estate, these have been 4 of the worst, or 5 of the worst sectors in the market. So I think what we saw on Friday, there was really 2 things I think driving the market Friday. Number one was options expiration. So we saw a lot of the stocks that were really strong and have been strong recently. They were doing okay in the morning, but I think as the day moved on, some of those stocks were weakening. And I think a lot of it was because there was a ton of in-the-money call premium on those stocks. So there was no financial interest for market makers to drive prices higher there. But in a lot of these other areas, there was plenty of incentive because many of the beaten down areas actually had max pain levels that were above current price. So first, when I look at the action across here, I see, the Dow was moving up, sideways consolidation, S&P 500 moving up, mostly sideways consolidation, a little bit of a upside slant there. NASDAQ much stronger. And then when you look at the mid caps, all last week, we were basically downtrending throughout the week. Same with small caps. And then on Friday, these 2 groups outperformed by a wide margin. Again, small caps 4.5%, mid caps close to 3 3/4. NASDAQ was only 1%. But again, this was the area of the market that had been so strong heading into options expiration. So I'm not surprised that the movement to the upside was more muted in the NASDAQ. S&P 500 and Dow, again, you can see mostly sideways action. When you come down and look at the sectors, these were really the 5 areas of the market that had struggled last week. Last week was a pretty good week, by the way. The S&P 500 finished up 3%. When you look at these sectors, though, you wouldn't really notice, or you wouldn't see it. I mean, energy was down until we went into Friday. Financials clearly down. Industrials down. Materials down. And real estate down. So all the groups that weren't participating last week came roaring back on Friday. Energy was up more than 10%. Well, if you went back and looked at the open interest in terms of the options, there was a ton of in-the-money puts, net in-the-money put premium. So movement up by the XLE by 10% actually helped cut into a lot of that net put premium. So, I think you got to take it a little bit with a grain of salt what happened on Friday because it was option expiration Friday. The other thing was on Thursday after the bell, Gilead Sciences came out and said that their drug. I'm probably going to butcher the name, remdesivir, something like that. But that drug was given to coronavirus patients in the Chicago area, one of the hospitals in the Chicago area. And the patients were suffering from some pretty severe symptoms. And once they were given this drug, their symptoms rapidly began to improve. I didn't see the percentage, but the study was pretty bullish. And so Gilead spiked on Friday morning. And of course, you know, if we all of a sudden have a treatment that works against the virus, we're talking about a game changer. So one of the things I started looking at on Friday, and I'm going to continue to look at for our members, Earnings Beats members this week, is, you know, do we see any discernible changes in the way the market is behaving? I mean, we saw it on Friday. You know, the two recent new chart lists that I created, one was a strong accumulation distribution chart list, which is companies that have appear to be accumulated since February 19th, really strong relative strength, very strong AD lines, accumulation distribution lines. And then the other chart list was the exact opposite. It was the weak accumulation distribution chart list. And these are companies that have poor relative strength and have awful looking accumulation distribution lines. And what I found on Friday is that they flipped. Now, again, it could have been options expiration, or it could have been the announcement on this drug, or maybe a combination of both of them. But I think this week's trading is going to be somewhat enlightening in whether or not the stock market really is putting a lot of weight into the announcement that Gilead had on Thursday, or if this change in character of the market that we saw on Friday is truly just a one-day thing, or maybe a couple of days based on options expiring. But that'll be something I continue to research throughout the week to see whether or not that continues to hold. All right, let's take a look at let's take a look first at the 10-year Treasury yield. Let me get an update here, because one of the problems I have in the market right now, you know, if there's one thing that just doesn't quite sit well with me with this rally that we've seen in stocks, is that the 10-year Treasury yield is not rallying. So, you know, we saw a lot of money go into cash back when the market was dropping. You know, it just makes sense when the market, you know, everyone gets fearful, you start to build up more cash. So I think the rally that we saw, or the rally that we've seen off the bottom on the S&P 500 across all of our major equity indexes, a lot of that can be attributed to the fact that there's just been some cash put back to work. What I haven't seen is a mass rotation. Now, if you look back in mid-March, we saw the 10-year Treasury yield rising. I think there was a lot of profit taking being done in treasuries because we had had such a huge run-up in treasury prices and a huge drop in the treasury yield. Those two always move 100% inversely to one another. So anytime you see what's going on with the 10-year treasury yield, the opposite is happening with treasury prices. So when you've got the yield going up like this, that means treasuries are being sold. Well, that cash many times will go into equities. So usually a rising treasury yield is good for stocks. But we actually bottomed around this time in the stock market while the yield was going up. And then when the yield started coming down, we were rallying. It was just kind of a crazy period. There really hasn't been that, you know, that normal intermarket relationship between bond prices and stock prices, or bond yields and stock prices. So one of the things I really want to see is the 10-year Treasury yield begin to trend above key moving averages. If the 10-year Treasury yield begins to move up and trend higher, that means Treasury prices are moving down, and it gives us a sense that the market is moving away from the more defensive Treasuries, and that would help to fuel a stock market rally. But as you can see here, that's not happening right now. And in fact, we're not far from breaking back down below about 0.57%, which we have not closed below since March 9th. And as the yield drops, again, that's just telling us more and more money rotating into the defensive treasuries. So this chart is one of those charts that I would put firmly in the bearish camp when you're looking at equities. If you're saying, hey, you know, I believe the stock market's going to go down, well, based on this chart, I would say this chart agrees with you. Money remains very defensive, and that's a good thing if you believe the stock market's going to go lower. But there's also other things that, I still think look more bullish. Many stocks, many stocks, especially tech names, healthcare names, breaking not just to 52-week highs, but the all-time highs. So while, the pandemic has been horrible for certain areas of the market, airlines, cruise lines, hotels, travel and tourism, those areas, you've got other areas of the market that have been doing extremely well, including, some of the broadline retailers, some of the specialty retailers that have online presence, healthcare, a lot of the healthcare areas, biotechs, pharmas, medical equipment companies, they have all been doing really well. So when you look at the S&P 500, that's a very diversified ETF that includes all of these types of companies, both bearish and bullish. So you're getting a watered down effect by looking at the spider. If you look at these individual groups, you begin to see, hey, there are bull markets out there. There are clearly bear markets out there. You just have to be willing to look for them and find them. Now, as far as the 10-year Treasury yield goes, economic reports tend to do a lot to influence the bond market. And so later this week, not really much out today, but tomorrow, March existing home sales come out. This is a lagging report. We're well into April, and we're just now getting March existing home sales. February was 5.77 million units, and we're looking for that number to drop to 5.4 million. So from 5.77 million in February to 5.4 million units. But the expectations, when I looked at the consensus estimates, 4.5 million to 5.95 million. So it's a huge range. And based on what I've seen in a lot of these March reports, my guess is we'll probably see numbers come in a little less than expected. The February FHFA house price index comes out on Wednesday. Again, that's February. This is really a lagging report, and they're actually expecting the number to rise 0.4%. So obviously, it's before all of this hit. January had a rise of 0.3%. I think the market's going to completely ignore that report. That's really the only one that comes out on Wednesday. Thursday, of course, initial jobless claims back out. Right now, the expectation is another 4 million claims. The range is 3 million to 4.5 million. We had 5.2 million last week. We've had, 16 million, something like that over the last 16 million over the last 3 weeks. Another 4 million expected this week. March new home sales expected out on Thursday, 632,000. February was 765,000. So a pretty big drop anticipated there. And then Friday, we've got April consumer sentiment. This is going to be an interesting report because March came in at 71.0, but it dropped a record 18.1 points from 89.1 in February to 71 in March. And for April, it's expected to come in at 68.1. But again, the range of estimates, 55 to 71. So the consensus is 68.1, but we've got somebody in there projecting 55. That would be another 16-point drop, which would be huge to the downside. I mean, to go from 89.1 in consumer sentiment to 55 2 months later would be unprecedented. March durable goods also out on Friday. So those are the reports that are going to be out later this week. Of course, earnings reports starting to come in. We'll take a look at some of those in just a minute. But first, let's talk about the S&P 500. Because, there's a lot of bears out there that swear we're going back down, that this is the Great Depression. But there's also a growing number of bulls. It's funny how a lot of folks get more and more bullish as prices go up. I mean, I'll admit I do the same. That's what the market does to you. It just kind of starts changing your thoughts and so forth. But I think what we need to do is focus on what the charts are saying. And I'm not a huge fan of technical analysis when the market's overly fearful, because I think a lot of times we see things in a fearful environment or a volatile environment that maybe supersedes technical analysis. But one thing that I do like to follow is Fibonacci, because I think Fibonacci, when you start having these big moves, there's just a lot of history where you can go back and see how the market historically tends to respond. Now, in 2008 and in 1987, we never got back above 50% retracement, the Fibonacci retracement from top of the major sell-off to the bottom of the major sell-off. That rebound was never more than 50% of the decline. The S&P has now moved above that. The next key level would be 61.8. And, I've got to mention that there was a pretty big resistance area. If you notice, we came down to about 2,900, held 2,900, went back up to 3,150. We're back in the 2,900s and we gapped down to 2,860, and that began this big sell-off. After gapping down, we came back one time, which I call reaction high, price reaction high, that came back up close to 2,900. So we've got this gap resistance, price reaction high right in here. We could also draw some support lines that came across from the August lows, maybe even also the early June low. Of course, we've gone through that number. We've gotten back above the 50-day moving average. That's a positive. We've seen the daily PPO turn positive, move back through the center line. That's a positive. These are some of the bullish signals. You can see the 20-day moving average is now rising with a PPO that's above the zero line. For me, that's the definition of a trending market to the upside. So given the historical background, knowing this is the week after options, the week that we could see a drop, from a bullish perspective, what I'm looking for is to see whether or not the breakout above the center line, the PPO being strong, the rising 20-day, we have not tested that 20-day on the S&P since we went above it back in the first week of April. So if we weaken this week and we do pull back, we've probably got about 4% or so before, maybe 4 to 5% before we hit that 20-day moving average. And when I looked last, we were down, I don't know, roughly about 2% in terms of, I'm going to pull that up to see where we are right now, in terms of futures. The Dow's down 2%, S&P's down 1.87%. So, about half of the move back down to the 20-day moving average may occur right at the opening bell. We'll see what happens from there. But I would be watching, down around the 20-day, maybe, after moving down here, we gapped up to about 26.90 or so. So that level is just below the 20-day. That might be an area to watch on the pullback to see if that holds. If that doesn't hold, then I think the bearish arguments begin to take on a little bit more oomph, if you will. They're going to have a lot more going for them if technically the sellers can take the price action on the S&P back below the 20-day and keep it there. On a close. Intraday, if we move below the 20 and come back up and close above it, that actually could be a very bullish short-term sign. We'll have to watch and see how things develop. But I do want to emphasize this is not a good week typically for the stock market. 19th to the 25th. It's the 20th. We're just starting this bearish period and it will last all week. So got to get through this historically and knowing that the market has come up. And I'm also going to add, let's get out of this for just a second. Instead of the accumulation distribution line, I want to show you the RSI. And this is the way my charts normally are set up without the accumulation distribution. I think that AD line has been really important to know and to see throughout this pandemic. But RSI, if you follow long-term downtrends or even short-term downtrends, when you're downtrending and you come back up and you get that RSI to move back into that 50-60 range, that can be an area for a top on a downtrend in a downtrending market. When you're uptrending in a serious uptrend, you can see we came down, touched 50, moved up, came down just above 40, started to move back up. That's where when you sell off and you get that RSI coming back down in the 40-50 range, that tends to be a good sign from a bullish perspective. Well, the opposite holds true. So if you're bearish and you're up into this level and you're looking at the RSI, you could point to it and say, hey, we haven't gotten through 60 yet. We're going to roll back over again. And I think it's possible. I believe based on the huge level of the volatility index when it got up into the 80s, which was earlier in March, by the time we got down to the low, I think the VIX had recovered some, maybe it was 50s or 60s. That's how the March 2009 low formed, by the way. Less volatility. So the market moved lower in March below the October and November 2008 lows, but the volatility index did not go back down anywhere near. So the fear was subsiding. And that's a little bit how this developed down here. But to go back down there, I think the VIX would have to really spike from where it is now. I think it closed. We'll look at that. I think it closed in the 30s last week. Yeah, 38.15, and it's been on a downtrend. So we bottomed on March 23rd, and you can see that we were right around 60 probably on the close, March 23rd. So we actually, when the prices were going down, so was the fear. So fear was starting to subside. And I believe on March 23rd, I could go back and look at a daily market report, but I think I pointed that out as a signal, a potential bullish signal for the market. When you start to see the VIX subside, fear is coming out of the market while you're continuing to move lower, that many times will be a good sign. And as I pointed out, March of 2009, that's exactly what we saw. Okay, what else do we have today? How about we take a look? Let's take a look at a couple of industry groups. Oh, actually, I wanted to show you one other thing, because on the S&P 500, if you're looking from a bullish perspective, to me, there's nothing more bullish than looking at the long-term 100-year monthly chart and just recognizing that we are in a secular bull market. And yes, the drop we've had has been severe. Some are calling it a depression. Right now, I think it looks no different than what we saw in 1987. 1987, we were in the midst of a really nice, when this all hit, it hit very quickly. We were in the midst of probably about the 6th, 7th year of a secular bull market where we had broken out above all the highs in the 70s and early 80s. And then this hit, the 1987 crash hit, where most of the losses occurred at the open, similar to this period. And then we simply marked a bottom and started trending back to the upside, continued that secular bull market. I think history could show that this little move to the downside, it's not been a little move, but when you look back in history, sometimes it looks more like a blip than it does a panic and a huge, massive bear market. I think, if we're looking in 10 years, we could look back and see exactly what we saw in 1987. So getting to the next 6 months or a year is going to be the bridge that we have to try to figure out how to cross that bridge and how to get there. But, so I definitely think that there's still the potential for more heartache in the short term, especially, as I said, if we don't hold on to that rising 20-day moving average on the S&P 500 and we start to roll over. We've got that level, the recent breakout, maybe around 2630 or so. Then you've got a little gap support. You got the recent pullback in April and then the low from March. So you got a lot of different levels that we could be looking at for possible reversals. But if we were to roll over from here, I think that would certainly give the bears the edge in the near term. Okay, let's move on, take a look at some of these industry groups first. So airlines, look at the accumulation distribution. You see how we had a bounce here, barely had any budge in the accumulation distribution. Then as soon as we sell off, right back down again. Here we get a nice little pop, maybe just a tiny little budge to the upside in the AD line, and then right back down again. When you look at all these candles, look for the hollow candles, because it's like trying to find Waldo in here. There's not very many of them. Well, actually, Waldo would be harder to find. You can actually spot these. They do stand out. But my point is, most of these candles are filled candles. And filled candles mean you're closing below the open. Closing below the open is a pretty good indication that there's a lot more sellers than there are buyers. So it's a signal that there's a lot of distribution taking place. And that is a problem when you see indexes, industry groups looking like this. I mean, if we pull up something else like the mortgage REITs, as we move down, look at the accumulation distribution line moving down. Now, if you want to see something that looks different, then you could take a look at maybe certainly biotechs. I mean, look at the biotechs. They broke out on Friday. Been talking a lot about them. When we went down, do you see the difference? Look at the move down. Look at all these hollow candles in here, a mixture of hollow and filled candles. The accumulation distribution went sideways. It did not go down with price. This low at the end of February, when we went way below in price, we never even went back and tested that low. And now that we're moving back up, we broke out before price broke out. We broke out on the AD line. That's a really good sign. Look at the broadline retailers. Check out, same thing. Look at the big move down. Look at all these hollow candles. Do you see the difference? So we were gapping down. These stocks were gapping down too. Broadline retailers were gapping down, just like airlines. But the difference was once the opening bell rang, a lot of buyers were coming into broadline retail. Hardly any buyers were coming into airlines. And that's been the difference in the market for the last 30 to 45 days. We've got areas that are being accumulated and we've got areas that are being distributed. And you've got to know which are which if you're trading this market. If you're into stocks in broadline retail, I mean, VIPS is a perfect example. VIPS, VIP shops. Check out, when it pulled back and all. Look at the accumulation distribution keep going up. It just went up and set a new high last week. It's important that you know these areas, and we've been stressing this at Earnings Beats. If you're not already a member at Earnings Beats, you might want to think about becoming one, because we're pointing out things a lot of people in the market are not pointing out. There are areas of this market that continue to go higher. There are other areas of this market that you want to stay away from or short. Just because the market's going down, would you want to short VIP shop? I don't think so. But maybe, maybe Delta Airlines might not be a bad short. Look at the move to the downside here. Every time you get a gap up, look at all these filled candles. That means if you get this stock when it's up in the morning and you short it, it's probably going to reverse to the downside, at least based on what it's been doing for the last 45 days. Very important to recognize the difference here. All right, earnings. Let's take a look at some of the earnings, just a couple of them. First, let's start with INFY, Infosys Technology. They matched expectations. Stock really not really doing that much in terms of accumulation distribution. I would not have been expecting a whole lot out of this report, given the, I'm going to go ahead and pull up the symbol summary and let's just see where we are pre-market. Stock's down 1%, not really doing a whole lot of anything there. What else do we have? How about MTB? This is one of the banks. So we've seen banks recently not doing very well in terms of their market reactions. You can see MTB, M&T Bank Corp. The overall, this AD line actually doesn't look as bad as some banks, but it's not great. They did beat 195 versus 155. How does that translate in terms of pre-market action? Flat. So coming out with a great earnings report, if you're a bank right now, doesn't necessarily mean too much, because banks are just been getting hit as treasury yields fall. And again, we're seeing that today. If I pull that up just to show you where we are right now, oops, let me do it on the, it's showing right now that we're down about 3 basis points, 6.2 or 0.626, which is about 0.63. When that yield goes down, that hurts banks. So we got to be careful there. Another company that reported, last one I'll show you here, Halliburton, HAL. They came out, they beat expectations, 31 cents versus 25. But what did that do in terms of the stock price? Absolutely nothing. This is a stock that's been getting killed, and it is down 10% in pre-market after earnings. Look at the accumulation distribution line. Came up a little bit on Friday, probably options related, and now right back down again with their earnings report. Got to be careful with these companies. If the bigger picture doesn't look very good in terms of accumulation distribution, I'd be careful. Upgrades and downgrades. I'm going to give you one of the upgrades here, which is a biotech, ABBV. Stock has been moving back up. Look at the AD line, much, much stronger. Even as the stock was going down here, the AD was getting stronger and stronger. You're much more likely, in my opinion, to see a sustained rally back to the upside if you have a strong AD line. DuPont upgraded, General Dynamics upgraded, Juniper Networks upgraded, among others. Downgrades, Boeing, shocker there. Disney was downgraded twice today. And actually one stock that got downgraded today is Peloton. Let's see what's going on here. Peloton broke out to its all-time high on Thursday, pulled back Friday, probably options related. And right now, Peloton is pre-market down 5%. Could be a good opportunity for the stock, actually. If you haven't gotten in, I liked it, talked about it, was back $27, $28. I think this is one of those stay-at-home stocks that could continue to do well for quite a while. So pulling back, getting close to that 20-day moving average could be an opportunity here. Disney downgraded twice. Packaging Corp of America, PKG, downgraded. Gilead downgraded. I mentioned their drug came out on Thursday. Good news there. And yet stock getting downgraded today. I think it was downgraded twice as well. Let's wrap this up with three you must see. What I did is I looked at some stocks on the S&P, or actually they were just large cap stocks that had pretty good scooters heading into Friday and pulled back Friday, and saw some pretty significant drops. One is Keysight Technology. So let's pull up KEYS. I just wanted to look at these charts and see if anything stood out. Well, I would say number one, accumulation distribution stopped going down. You see a lot of hollow candles. I think this is boding better for this stock as we go forward. But it does have a lot of overhead resistance. 97.5 up to 100 is going to be a tough area. 100 was holding as support until we got the breakdown in January. Reaction highs right up to 100. So you got to get through 100, but with the AD line not doing too badly, I think a gap down getting close to that 20-day moving average could be interesting here on Keysight Technologies. Next up, Xilinx. This is in the semiconductor area. Stock that really had been a poor performer for quite a while. Semis, a lot of them have bounced back. This one's bounced back, starting to show a little bit of strength in the AD line, but I still think right now there are a lot of other semiconductors I like better than Xilinx. And then the last one is Hershey's. Hershey's has actually stayed up pretty nicely on its accumulation distribution, even though it had the big move down. So I think pullbacks, close to that 20-day moving average could be an opportunity for a stock like Hershey's. All right, we are going to wrap it up. Let me just give you a quick update on the market since it did just open about a minute and a half ago. Right now, we've got the Dow down 456, S&P down 44, NASDAQ down 90, NASDAQ down 1%, Dow down almost 2%. VIX is up about 9.5% today. We'll see whether or not that holds. Keep in mind one thing. Throughout a lot of this downtrend, the reason we're seeing strong AD lines is we're seeing a lot of the gap downs like we're seeing today, and the market has rallied off of these gap downs. Not every day, but we have seen quite a few gap downs and then recovery. That's going to be something to continue to watch this week to see if the market continues to follow that path. If you were going to trade that path, in other words, being down today, I would look for some of the stocks, particularly Earnings Beats members. Go to the strong AD chart list. Take a look for some of the stocks that are getting hit hard today. Look on the charts. If they're hitting their 20-day moving average or maybe moving below, and they come back up above that 20-day, that might be the time to take a shot. Again, you have no commissions in trading, so you can take small positions. You don't need to think about, oh, well, my commissions are going to, eat up. You could buy 10 shares of a stock, 3 shares of a stock. Doesn't matter. You don't pay a commission. So there's a way to try to make a little money here based on what the market's been doing without, throwing in taking out a second mortgage on your house. I wouldn't be doing that in this kind of an environment. Anyway, that's it for today. Those of you that are Earnings Beats members, I'll be back later today with the daily market report, let you know what I'm seeing. For those of you that are not Earnings Beats members, we have a free trial really for 30 days. It's $7, but we will refund it to you in a few business days. So net, it is $0, but check us out. Go to earningsbeats.com and sign up for your free 30-day trial. I think you will be happy you did. Everybody have a great day. Be back tomorrow over at Stock Charts TV for the next episode of Trading Places Live. Have a great day, everybody. Happy trading.